Let's be real. If you're serious about building wealth, getting into investing can feel, well, pretty overwhelming. It's like you're staring at this giant mountain with no idea how to even start climbing. But what if I told you there's a simple, proven path right to the top? Today, we're going to demystify it all. We're focusing on one of the most powerful and easy-to-use strategies out there, building your wealth with Fidelity's low-cost index funds.
This video is for educational purposes only and does not constitute financial advice. Always do your own research and consult a licensed financial advisor before making investment decisions.
So here's our game plan. First, we'll tackle that huge challenge every new investor runs into. Then, I'm going to show you a simple but really powerful solution. We'll use that to build your core US portfolio, touch on how to diversify a bit, and then wrap it all up with why Fidelity just makes this whole thing so darn easy. All right, first up, the challenge. You know that feeling when you're trying to decide where to put your money and you just freeze? If you've ever felt that, trust me, you are not alone. To put this into perspective, Fidelity, just Fidelity alone, offers over 9,000 different funds. No, that is not a typo. Over 9,000 choices. It's the classic definition of analysis paralysis, right? I mean, with all that noise, how in the world are you supposed to find the right signal? The biggest danger here isn't just getting stuck in doing nothing. It's actually picking the wrong thing. You know, these funds with sneaky high fees that just slowly and quietly drain your returns year after year. But here's the good news. There is a simple, proven way to cut through all of that complexity. And it all comes down to harnessing the incredible power of index funds. And hey, you don't have to take my word for it. Warren Buffett, literally one of the most successful investors in history, has said time and time again that for most of us, a simple low-cost index fund is the smartest way to go. That's about as good an endorsement as you can get. So what is an index fund anyway? Think of it like this. It's basically a giant basket of stocks that's built to just mirror a market index, like the S&P 500. So instead of trying to pick winning companies, you're just buying a tiny slice of the entire market. Boom. You get instant diversification, and because it's managed passively, the costs are kept incredibly low. Okay, enough theory. Let's get practical. To build the foundation of your portfolio, you really only need to make one single choice when it comes to the US stock market. You've got two fantastic options right here. On one side, you've got FXAIX, which tracks the S&P 500. That's the 500 biggest companies in the US. On the other side, you've got FSKAX, which tracks the entire US stock market. We're talking over 3,800 companies. Now look at that 10-year growth. It's pretty much identical. So why is that? Well, here's the key. These funds are market cap weighted. All that means is that giants like Apple and Microsoft have a way bigger impact than all the thousands of smaller companies combined. In fact, the S&P 500 already makes up about 80% of the whole market's value. So the bottom line is, you honestly can't go wrong with either one. Just pick one and make it the bedrock of your portfolio. But hang on, it gets even better. Fidelity has this incredible ace up its sleeve, a special group of funds that are completely 100% free to own. Yep, a 0% expense ratio. This is a total game changer. And here they are. FNLX is the zero-fee version of an S&P 500 fund, and FZROX is the zero-fee total market fund. Now, technically, they track Fidelity's own internal indexes, but for all practical purposes, their holdings and their performance are nearly identical to the funds we just looked at. You get the same awesome market exposure, but you pay absolutely nothing for it.
Okay, so once you have that solid US foundation set, then you can start to think about adding a few other things to the mix. Maybe something for a little more growth potential or some global exposure.
For example, if you're okay with a bit more risk and you have a long time to invest, you could add a fund like FNCMX, which tracks the tech-heavy NASDAQ. As you can see, it has higher growth potential, but, and this is super important, it comes with a much bumpier ride day to day, and it has a higher expense ratio. Think of this as an option for a small piece of your portfolio, not a requirement. You can also spread your bets geographically. A fund like FZILX, which, by the way, is another one of Fidelity's zero-expense funds, gives you exposure to companies outside the US. This can be a nice cushion if the US market hits a rough patch. Since the US has historically been such a powerhouse, a lot of investors just treat international stocks as a garnish, a little something extra on top of their main portfolio. So, we've covered the what to invest in. Now let's talk about the where. because the Fidelity platform itself is really what ties all this together and makes it so powerful for do-it-yourself investors.
The advantages here are just really compelling. We've talked about the zero funds, but you also get zero commission trades on stocks and ETFs. They have basically every type of account you could ever need. Retirement, health savings, you name it. They have an amazing cash management account, they reimburse all your ATM fees anywhere in the world, and their security is top-notch. It's truly a one-stop shop.
You know, I have to spend an extra second on that cash management account because it's just so good. It can literally replace your checking account. But the amazing part is that any cash you have that's not invested is automatically swept into a high-yield money market fund, like FXAIX. So your cash is never just sitting there doing nothing. It's always working for you, earning a really competitive interest rate.
And all of this brings us to the actual strategy, which is so simple but so effective. Step 1, set up automatic transfers from your bank account. Step 2, create recurring investments into the index funds you chose. And step 3, this is the hardest part, just be patient. Let the magic of compounding do all the heavy lifting for you. This set-it-and-forget-it approach is a truly proven path to building real wealth over time.
So there you have it. The roadmap is laid out. All that complexity has been stripped away, and what's left is a simple, powerful, and actionable strategy. The only question left is, what's your first step going to be?